Good evening, everyone. Welcome to Market Monday. My name's Dave Huber, and I will be your host this evening as we kind of give a recap on what's happening in today's market. Usually we have Blair Nightingale running these Market Mondays, but he is enjoying a much-deserved time away where he has the ability to just recoup and regenerate. He has been working so hard for us at Tradeway, and many of you have had an opportunity to spend some time with him at a Trade Surge class. You've probably seen him there, or you've just seen him frequently on social media. So you get me today, and I'm very happy to be with you. I can't wait to kind of dive into what you can expect in the market. There's a lot of confusion as to why the market's going down when there were great numbers in the Black Friday sales. So we're going to get into that. It's actually not one of the main driving forces of the market, but we will talk briefly about Black Friday. And what we'll do today is we're going to get into just the meat of the matter, what's really truly driving the market. And we're going to start off by looking at some of the numbers that have been reported. And then we're going to look at the chart and look at some of the technical analysis of the market. So we're going to do a little tiny bit of fundamental analysis here, a little technical analysis, and that's going to give us some great insight into market tone. So if you're joining us live, thanks for being on. Drop us some love in the comments section. Don't forget to hit the like, subscribe, or whatever else you do on YouTube and Facebook. Make sure that you hit the notification bell so that you can always make sure you get these videos as they come out, and you can join us live. We'd love to have you join us live. Now, many of you are thinking, all right, what's going to happen in the market? I'm getting ready for some trading. I need to know which way to expect it to go. Remember, we don't know which way the market's going to go. We let the market tell us which way it's going to go. And it's actually telling us a pretty clear story right now. So we've got some clear lines we're going to draw on here, and it's going to make it make a lot of sense. But I want to talk a little bit about some of the numbers first. If any of you read an article on Yahoo Finance, the big article today was about the manufacturing numbers, the ISM manufacturing, and something else called, the name escapes me right now. In fact, I can actually go and look at it right here with you while I'm on. It's another term for ISM manufacturing. It's the Purchasing Manager Index, PMI. That's what it is, Purchasing Manager Index. So if you read the article this morning about that, probably what you saw was that it said that the manufacturing, the ISM manufacturing number was expanding, and the Purchasing Manager Index showed a slight expansion, but it was actually less than what was expected, something like that, showing in the 40s. Here's what I want you to understand. Those two numbers are the same. Like that, when they report on ISM manufacturing or PMI, those are the same numbers. So actually, if you read that carefully, you're going to see that it's actually quoting two different reports that are reporting on the same number. So if you're getting a little confused about which one is more important, it's actually the same reporting. So if you see ISM manufacturing and PMI Purchasing Managers Index, if you see those numbers together, they're the one and the same. And in fact, sometimes they will call it the ISM PMI. And so don't get that confused. Okay. Don't think that one is showing one thing and the other is showing another thing. Really, what they were trying to do was create some confusion around some otherwise pretty bad numbers. And what was bad about them? Well, if you read the article, you'll see that it says that manufacturing is up, right? Manufacturing is up 56.5 when the estimates were 53.5, which means it was hotter than expected. Manufacturing was up more than the analysts projected it to be. Now, that sounds like a good thing, right? We want manufacturing here in America. We want things to go well. We want more jobs and things, right? But right now we are trying to fight inflation. And the way you fight inflation is that you try to cool down the economy. And you do that by making money more expensive. That's what the Federal Reserve is trying to do by raising interest rates. That's the cost of borrowing money. So when they raise interest rates, it causes money to be more expensive, which means it should buy more things, right? Because money is now more valuable. Now, usually when that is working, what you see is the economy begins to slow down. You see manufacturing contracting, you see unemployment go up, you see wages come down. Basically, businesses begin to go into saving mode. And when they go into saving mode, the economy contracts a little bit and we have what's called a recession. Well, they don't want to claim that it's a recession, although it's way past claiming time for that. We've been in a recession now for quite some time, since January, but officially since we had 2 quarters of continually down GDP. So let's break this number down and let me help you understand what it actually means. When it says that manufacturing is expanding, it's the number that we're looking for is 50 or below. All right. 50 means it's kind of stagnant. Below 50 means it's contracting. So they were expecting that it was still going to be expanding a little bit, and they were expecting 53.5 to be the number that comes out. Well, it beat the expectations and came out at 56.5, which means the economy is still hotter than the analysts projected it would be. What does that mean? Well, that means businesses are ramping up what they produce. The only reason why businesses do that is because they want to try and meet a perceived demand, which means there are a whole lot of people who still want to buy a lot of stuff. Now, another way we can see if the economy is contracting is through unemployment. So let's look at the jobs data that just came out. Jobs were hot also. 263,000 jobs were added in November. That's up higher than the expected 200,000 jobs. What does that mean? That means that companies are hiring at a faster rate than the analysts expected. So here are the analysts saying, okay, we think that the economy is going to be slowing down. So we expect to see certain numbers. In the manufacturing realm, they were expecting to see 53.5. In the jobs added realm, they're expecting to see about 200,000. They missed by a mile. So this is really bad news. It sounds like it should be good news because we want jobs and we don't want to see unemployment go up. However, we have to get our price under control. If we have runaway price, then we are going to have a very difficult time in our economy. What you're going to see is just a widening of the income brackets. You're going to see the rich get richer and the poor get poorer because now your groceries begin to be a lot more expensive. Your gas begins to be a lot more expensive. Your travel, everything that you do, your energy, all of it gets more expensive. And that really hurts the middle income more than anybody. The middle class gets hurt more than anybody when that happens. And so what we really want to see that's healthy for the market is we want to see these numbers contracting. We want to see manufacturing to be at 50 or below. It would have been great if we'd have just seen 53.5 because that would have meant that we're coming down close to 50, right? We're trying to get to a contractionary state in our economy just in time to get control of inflation. It's not like we want to stay there, all right? So manufacturing is hotter than expected. So we're producing more than we expected to be producing. We're adding more jobs than we expected to be adding. So what does that mean? Companies still see that there is a huge demand and they want to go and make money off of it. So they're still producing a lot. They're still hiring new employees, and that's going to make the economy boom. And you say, okay, well, if the economy's booming, why is the market going down? Well, the reason why the market's going down is that the market knows that the Federal Reserve has to get price under control. It has to get on top of this inflation. And if the market is still booming, then the economy is still hot and prices are still going to rise. Why are they still going to rise? Well, think about this. People are making more money because they've got more jobs. All right. And speaking of money, by the way, more numbers came out. October's payroll was upwardly revised. What does that mean? Well, we looked at October's payroll last month, and there was a number that was reported. I say our government. They reported a number, and everybody got excited because it looked like things were cooling down. This month, they're saying actually that number was wrong and we have to increase it. How sneaky is that? So they misrepresented last month's payroll numbers. And what does that mean? People made a lot more money than we reported last month. Well, when people make more money, what do? They spend more money. And if they spend more money, what happens to price? The price goes up because people are buying. It's a whole supply and demand issue. All right, so then on top of this, we look at payroll, the average hourly earnings payroll. If you look at average hourly earnings from month to month, it's way up, way up. All right, so 0.6 is what they reported for this month in November, this last month, November. And it was expected to be 0.3. So that's twice as high in average hourly earnings month to month than expected. What does that mean? People are making more money. If they're making more money, what are they going to do? They're going to spend more money. If they're spending more money, what's going to happen? You're going to see a boom in price yet again. Inflation's not over yet. All right. Now, we may still be seeing some beginning signs that inflation's going to be cooling off, but that's not yet. It hasn't happened yet. We're not on top of it. Average hourly earnings year to year, not quite as bad as the month to month numbers, but still pretty bad. 5.1 compared to 4.6% up. All right. So it's a 5.1% increase compared to 4.6. That's not what we want to see. So what does this mean? Companies are making more products. All right. Which means they believe they're going to be selling more products. They are hiring more people to sell more products, which means there are more people with money, which means there are more people who will buy things, which drives the demand up for more products. See, it's kind of a really bad cycle we're in. And those people are making more money. If people are making more money, they have discretionary funds to spend. Now, granted, even though the wages are up, it's still not keeping up with inflation. So that's pretty bad. Things are getting more expensive, but we're just not feeling it as much yet. See, that's where the trick is. People aren't feeling the increase as much as they should. Now, you might be thinking, are you serious? Like we should be feeling a bigger increase in prices? Unfortunately, yeah. But with wages going up, there are many who are not going to feel it just yet. However, that's just a foregone conclusion. It's going to happen. So when the market sees that the economy is still hot, they go, uh-oh, the Fed is going to have to raise interest rates some more. So when you see the market crash like it has today, and it was a pretty good move down, 72 points down in a day, that represents almost 2% of loss in the market. It's 1.79%. When that happens, you're seeing them look forward to, okay, the Fed is going to have to raise interest rates again. There's already talk that they're going to have to add maybe as much as another 5% to interest rates in 2023. That's a lot, guys. That is a whole lot. So you may be seeing this market go into a recessionary spiral for quite some time. Now, what does that mean? Those are the fundamentals, by the way. That's just looking at the numbers and saying, okay, now we know the story behind what the market should be doing. Let's take a look at what the market is doing and see if it backs up those numbers. So you'll notice we've been in a little bit of a recession since January. I'm going to go ahead and draw some lines on here for you guys so you can see the resistance line that we actually just hit 2-3 days ago. Look at this. It's a pretty solid resistance on the market. I'm going to zoom in just a tad here for you so you can see up close. Yeah, I mean, it's following the 200-day moving average. That's a simple moving average for those of you who are wondering, not an exponential. And we just got a great bounce down off of this resistance line. Now, David Mitchell's been talking about this for quite some time. So if you've heard from him in market alerts or in amped alerts, he's been talking about how this is not done. He doesn't believe that the recession is done yet. I tend to agree. I mean, look at this. We had a great move down on both of these. And you know, even though we had this move up and it was on pretty good volume, that was because everybody was thinking, yeah, inflation, we're starting to get on top of it. But when you see these hot jobs numbers and wage numbers go up, that's very disconcerting. We're not on top of it yet. Now, we may be starting to turn the tide a little. That's encouraging. but it's not enough. We've got to get it down some more. So let's go ahead and draw a support line on this as well. I'll throw a parallel support, and then I'm going to show you how I am going to watch for entering new plays in the market. Okay. So here's the resistance line. We've got great bounces down. We're going to draw a parallel line to this. Here we go. Just going to make that as parallel as I can get it there. That's pretty good. And we'll zoom out so we can get a real good picture of what's going on here. We have a little bit of an anomaly here. But yeah, this is a pretty solid support line. You can tell we're in a very pretty downtrend. So if you know how to do step 2 option strategies, guys, this is a great environment for that, right? We're beginning to see a very predictable downtrend. And so if this holds true and we don't get on top of inflation sooner rather than later, then you may have some opportunities for some put plays in the near future. How will we know when it's time to buy put plays? Let me show you what I'll be watching. So anytime you've got this real pretty downtrend, you want to kind of watch the retracements. The retracement is the move from bottom to top, and then it retraces from top to bottom, right? So anytime the market, and that's what we're looking at now, the S&P, anytime the market moves all the way to support and then turns around and goes up to resistance, we call that a retracement up to resistance, right? And now it's retraced back down to support. It tries to go up to resistance, fails a little bit. There's a lot of weakness in here. Then we get some hope that maybe we're turning the tide on inflation. It moves up, comes back down. And now we've got, more recently, we've said, okay, it looks like we may be able to slow down the rate hikes. That's what Jerome Powell said at his last rate hike, saying that he thinks we may be able to start slowing down. However, this job data and this wage data and this manufacturing data may make him change his mind. Or if he does slow down, it won't be a very aggressive slowdown. It'll be a very, very slight slowing down, a cooling off period on these interest rates. So here's what I'm going to do. I'm going to watch this retracement to see when I would want to enter put plays. Here's how I do that. I'm going to grab another line, and I'm just going to draw as if there is a support line right in here. Now I'm going to zoom way in so that you guys can see. What we're doing is we're going to treat this recent retracement as if it's this little uptrend. We got to get these lines just right here. Let's see. Let's get this. Here's my other point. We're going to bring it way down here. And you'll notice if we just grab those last 2 times that this has bounced, we go off of those lines. We'll go off the wick here. You'll notice that we're getting close to this line again. Now we will see one of 2 things. We will either see that this market will move on down and hit that again, which would line it up perfectly with the 20-day moving average, and it will bounce up if it wants to try and move up through the downtrending resistance line on the market as a whole. So here, if we zoom out, what we're looking for, is it going to bounce the 20-day? If it does, it may try to push up through resistance. That would not mean that this recession is over, guys, because we are coming out of a slight anomaly down here. So there's a little bit of buying momentum. So the market as a whole just has this propensity to move up. It got a little scared today, but we're going to see if that fear grips the market. If it does, we're going to see a new retracement down, and you're going to see it break this line. As soon as it does that, if it breaks this line right here and it gets down below that 20-day moving average, there is a distinct possibility that you're going to get a full retracement on this market, maybe all the way down to its former support line, or to its current support line, I should say. If that happens, you're going to see a pretty bad shaking out in the market here. And what that could mean is it could mean that you have an excellent opportunity for some put strategy. So for those of you who've been through step 2 and you know how to do put option strategies, there may be an opportunity here. It's not quite time to buy it just yet. Now, if you're looking at this more long-term, you could. If you're looking at this like a long-term buy and hold for the down, I do believe that we're going to be getting a retracement. But if you want to try to time this thing to be at a more accurate buy point for short-term trades, it would be a good idea to wait for it to just break down through this uptrending, it's not really an uptrending line, but the retracement line up here. So you want to see it break through that. Once it breaks through that retracement line, then you really don't have a whole lot that can prop it back up. You might start looking at horizontal lines. That's one thing that I like to do. As soon as I see the market break one way or the other, I like to really see where it could go to. And I always start with horizontal lines, places where it's turned in the past. This is a slight horizontal line. It's not great, but I think if we were to zoom back out, we may see that it hits a few more places. Yeah, there, right back in here, it does. And so we do have a little bit of a horizontal price line, which, by the way, lined up absolutely perfectly. Look at that. It lined up perfectly with the downtrending resistance. So if you timed that and got into puts right here, it would have been a pretty spectacular call. But those of y'all who are trying to be a little bit more cautious and not get burned at the turn, that's good for you. Well done. We're going to wait for this to come down, and we'd love to see it break through and make kind of a lower low here. If that happens, then we could play it all the way down to this horizontal and maybe bump up stop losses as it nears that horizontal. If that happens, we wait to see if it breaks through. If it does, you're going to get even further down here. We could get a pretty great move on a put trade if that's what you guys are looking at. So anyway, guys, here's what you need to think about, the big takeaways in the market. It's all about the interest rates, right? Are they going to keep raising interest rates? If they are, the market hates it. It's going to continue to go down in a recession. Why? Because currently on bonds right now, you can make just as much of a return as you could just by getting dividends off of a stock, right? So you could actually make that's a potential out there right now. Some of the bonds have just as much of a yield, or at least close enough of a yield, where the risk of holding stocks, blue chips that pay a dividend, it just doesn't make sense. Just get in bonds and make some money the safer route there through debt instruments. That's what the big boys are thinking right now, right? So long as interest rates keep going up, the big boys are going to park their money over in bonds. So that's kind of the thing you want to watch right now, is which way are the interest rates going. With the numbers that we're seeing come out, manufacturing up, data on jobs, more jobs being added than expected, data on wages higher than expected. All that shows is that there's too many people with too much money and not enough product to satisfy the demand. If that's the case, inflation keeps going up. If inflation keeps going up, you can bet the Fed is going to have to remain hawkish and say, all right, let's increase interest rates more until we can cool off the economy. And when that happens, you just see the market crash. So really, this is not that hard to trade in. This environment is really not that difficult, guys. You just have to watch and see what is the Fed likely to do with interest rates, and what are the numbers going to dictate that they will do. Right now, the numbers dictate that they have to keep raising interest rates. Are they going to start spinning the news so that we don't continue in a recession in the near future? Yes, they will continue to spin the news, but that will not necessarily pull us out of a recession. All that does is it creates a lot of suckers, a lot of people who go, oh, well, they said we're finally on top of it. They said we're finally coming out of this recession. It's almost over. The end is near. When you start seeing all that, take it with a grain of salt. What we want to see is inflation on the decline. Our ideal inflation rate is about 2%. Donald Trump will tell you 1 to 2%, right? But most analysts or most economists agree that it should be around 2%. And we're well over that right now. So because of that, we have to expect that the market is going to continue down so long as the Fed continues raising rates. Now, the Fed is trying to make it sound like they're not going to raise rates as quickly, but they are not making it sound like they won't raise rates. So what does that mean? Get ready for more recession. I think we're going to see a retracement in the near future, but we don't know how near that future is, right? We could see a temporary bounce off of the 20-day moving average. It could move up through resistance and even flirt around with this old horizontal line for a little bit to make an offsetting anomaly to the most recent anomaly, right? So if that happens, that would not be too far-fetched. That's very possible. And that's why I'm not hopping in put plays as of right now. I'm going to wait. And I'd love to see it break the 20-day moving average, which I think you're going to see is going to follow this little retracement support line quite nicely. You're going to see that tick up tomorrow and the next day. So if we see a candlestick break down below this and we see good volume on that, there's a good chance that we'll see a retracement down in the market. But again, we don't know when that is, so we let the market tell us what it's going to do. So that's the Market Monday for this week. Guys, I hope that was helpful for you. If you're looking at getting into up trades, now's not the best time to do it. You've got the 20-day moving average that we're really close to, that it has tended to bounce off of over the last month. So there's a chance that you see it move up slightly in the near term, but that's more than likely a temporary move as the market numbers are coming out and showing us we need to keep raising interest rates. The Federal Reserve and Jerome Powell, the chair of the Federal Reserve, is going to continue to try to spin the news, make it sound a little more dovish. And you're going to see that all over news articles on Yahoo and Google and you name it. Everybody's going to try and get happy about this market going up. I wouldn't fall for it. I'd wait and see, does it break resistance and does it do so on higher volume? If so, maybe we can start having the discussion that this recession is over, but I don't see any reason why it's going to be over as of yet. So if you were hoping for a recovery, sorry, that's not the news you wanted. But if you were already suspecting that we were kind of nearing the top and we need to see a new retracement, good for you. The numbers back you up there. There's a likelihood that we will see this retrace on down from resistance. But again, we wait and we let the market tell us what it's going to do. We could squeeze up in this point here. And if we do, it's just going to be a few days before we know truly what the market's going to have for us. So that's our Market Monday. I hope you've enjoyed it. I hope this gives you some clarity as to what to expect in the market. Don't let confusing articles could, make you jump the gun a little bit and get into some up plays before you should. Be patient and call us up at Tradeway. Shoot us an email, support@tradeway.com. Let us know what your thoughts are. Throw it in the comments section, how you were thinking coming into Market Monday today. I'd love to know what were your thoughts going into Market Monday? And now that you've heard the analysis, what are your thoughts coming out of it? I hope you've enjoyed it. Can't wait to see what you guys do with all your trading. Don't forget to call your coach, and we'll see you again next Monday for Market Monday. Also, I need to make sure that you guys know something that we're doing. We've got a topical workshop coming up, and I have that. Let's see, I've got that in my notes here. I want to make sure that I say right when it is here. The 13th topical workshop on the 13th of December 13th. That's my wife's birthday. So now I won't forget. All right. So 11 a.m. Central Time is when this topical workshop is going to be running. And it's going to be my good friend, Jeffrey Nance. I call him Geo. He will give you the trading year in review. And that's going to be so important because when you go and look at the past, you can learn from it. They say those who don't learn from the past are doomed to repeat it. So if you had a terrible trading year, it's time to kind of look at the year in retrospect. Let a coach walk you through what was happening so that you can turn those losses into learning opportunities if you so had some, right? So if you had loss in this last year, we want to turn that into a positive for you. You do not want to miss Trading Year in Review. That's going to be on December 13th at 11 a.m. Put it in your calendars. Ruth, glad to see you made it on here. Escapade, glad to see you on here. So make sure you put this in your calendars, December 13th, and that's going to be at 11 a.m. Central Time. You do not want to miss this free topical workshop by Jeffrey Nance. It's going to be an excellent look at the trading year in review, and it could give you the insight you need to make next year's trading even better. So we'll see you again next week. We'll also see you in the workshop on December 13th. Put it in your phone so you don't forget. Hit the like, subscribe button, the notification bell, do all the social media things so that you don't miss these lives with Tradeway at Market Monday. And then, guys, we'll see you in the market. Y'all take care.